You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Before we begin today, I want to remind you that there's a website associated with this particular show. It's called wealthformula.com. Go and check that out for various resources. Also, if you're interested in potentially joining our small group and our community online, it starts with a course. Go to wealthformularoadmap.com. Check that out. There's a course that is on some of the basics of personal finance. And then that sort of leads into this group that we call Wealth Formula Network. Wealth Formula Network is, an online, not only online, but also a Zoom and online community. We have a Facebook group. We have a Zoom meeting every other Wednesday. And anyway, people, I think, get a lot of benefit from it. It also allows me to speak with greater candor on issues that I know some of you would like to hear. But unfortunately, in public, I can't do that. So check that out, wealthformularoadmap.com. As for today, I want to talk to you a little bit about something that we talk about a fair amount there, which is the role of potentially a permanent life insurance in a portfolio. Right now there's a significant amount of distress in the investor world right now, right? It's not just you and it's not just me. There's a lot of distress out there, and with inflation and interest rates climbing quickly, it has left equity and real estate markets in shambles. And you know what? We'll get through this. We will. And while I encourage you to fight against the fear of investing so that you take advantage of any oncoming blood in the streets, I understand if you are reluctant. I totally get it. That is sort of, the right evolutionary reaction to have to danger is not to run right into it, right? But anyway, we've talked about this before. You have to try to change your mindset a little bit. We've had tough times in American history, in American economic history, that is. And the Great Depression of the 1930s, was a period of extreme economic hardship and uncertainty. And that started off with a stock market crash and what's called Black Tuesday, October 29th. Dow Jones Industrial Average lost about 12% of its value that day, and the crash continued into the following weeks. And by mid-November 1929, the market had lost over $30 billion in value, which is approximately $400 billion in today's terms. And that loss of wealth led to reduced consumer spending and investment, which in turn led to job losses and business closures. There's a vicious cycle that ultimately ended up being called the Great Depression. Now, I should point out, though, that it wasn't just stocks. Real estate is a correlated asset, and real estate prices fell significantly during the Great Depression as well. People weren't able to afford to keep their homes or buy new ones, and that led to a surplus of available properties and a corresponding drop in prices. However, what's interesting, and I think this is something to think about today, the life insurance companies displayed a surprising level of resilience even during the Great Depression. And while it was a challenging time for these companies, as it was for the entire economy, they weathered the storm better than many other types of businesses. And for this reason, an entire generation of individuals put a premium on permanent life insurance as an investment. It was all they had once the dust of the Depression had settled. Nevertheless, the next generation of Americans forgot. They forgot about the Depression, the value of permanent life insurance. It sounded boring. Even though it had played a significant role in their parents' survival, the Depression was out of sight and out of mind. And even with insurance strategies that significantly increased investor returns, financial advisors focused on their personal AUM, and they continue to treat it like a red-headed stepchild. As you may know, I actually am a big advocate of permanent life insurance, specifically overfunded type policies such as Wealth Formula Banking and what we call Wealth Accelerator. Now, I should point out that I wasn't always that way. I mean, I didn't know, because when I left residency training and tried to learn a little bit about what I was supposed to do, everybody told me that I wasn't supposed to buy permanent life insurance. They said, don't buy it. Take term, invest the rest. And I didn't even know what that meant, but I said, okay, sounds good. And so it wasn't until I realized that a bunch of, rich people around me were buying permanent life insurance that I realized, you know what, there's something else to this. Fast forward to where we are now, these policies, they've been a source of ongoing profitability and stability for me. Like many of you, my portfolio has been hit by everything that's ensued here, but at least I know I've got this, and at least I know if something happened to me, my kids would be taken care of as well. Even in times where my portfolio is taking such a beating, I can count on the insurance portion of my net worth, which is actually very, very, it's nice to have. It's funny when it's exciting times, right? Like insurance is really boring. And when things go really south, it's like, oh, thank goodness for boring. And anyway, so I thought about this a lot last week and decided to bring it back on your radar. So I invited our insurance partners back to the show. If you haven't yet secured life insurance, permanent life insurance is part of your portfolio, make sure to listen to this week's episode of Wealth Formula Podcast, the interview with Rod and Brennan, when we come back from these messages. Welcome back to the show, everyone. Today, my guests on Wealth Formula Podcast are well known to this group. They are the Wealth Formula Banking folks named Rod Zabriskie, and we also have Brennan. Brennan, you haven't been on this show before, though, have you? It's usually Christian.
Yeah, I think, man, I'm trying to think. Did we do one episode before, Rod, or am I thinking of a webinar we did?
Maybe we've done some stuff, and Brennan's joined us at some of the meetups and stuff, so he's been around.
Okay. Not the podcast, though.
No. Yeah, no, I've definitely, we've seen you around and stuff at the meetups and that kind of thing. But anyway, welcome to Wealth Formula Podcast again, guys, and it's
Thanks, Bud.
Happy summer to you. As you can tell, if you are watching this on video, I am extraordinarily informal today. Just got back from a kickboxing little exercise morning here, and got the Wealth Formula hat on instead of trying to look nice for people. So
repping the brand.
That's right. So guys, I'm glad you made it on. And, I was thinking about this show the last few weeks because it's like, we've got some rough waters on the investor side, and it made me start to think about, well, where do you deploy in times like these? Because there's always places to deploy capital and that kind of thing. And the obvious one to me seemed to be, something like what you guys are doing with Wealth Formula Banking and various permanent insurance things. And so I thought, let's back up. Let's tell the story here, because this is a historical, this is something that has been an issue throughout history where people have fallen back on to the permanent life insurance thing. So let's talk first. Let's way back up. How did the concept of permanent life insurance come into existence in the first place? And what is it? That's the other thing.
Sure. Yeah. So I can answer that one. Life insurance, as it was originally, conceived, was what's called annual renewable term. And all that means is if I pay my premium, if I die this year, my insurance pays out. If I don't die this year, then next year they'll bill me again, and I'll pay a little bit more, because as I get older, the cost gets higher. The statistically, I'm more likely to die, and so they'll charge me more for the insurance.
Is this is this American stuff that you're talking about, or is this like going back to medieval European history and that kind of thing?
Yeah, well, I think it even goes back to the Middle East, right?
Oh, okay, got it.
So, and it's just pooling risk, right? Like buddies get together and say, hey, I don't think I'm going to die, but if I die, I'd like to have something for my family, and everyone else agrees. And so they say, well, let's all pony up, a little bit. And then if any of us dies this year, then that money goes to that family.
So it's sort of like captive insurance.
It's like self-insuring, but I don't want to self-insure. I want to pool it with a few others. Then the insurance companies, the way they are now, it's just like millions of people pooling together and saying, hey, I don't think I'm going to die, but just in case, here you go.
Right. So of course it has evolved over the years. And so, talk us a little bit about that over the years in terms of policy structure and benefits and all that. And, at what point did the concept of term insurance come up, and what just in general?
Sure. So that model, it works great for a little while. If you're in your 30s and you say, well, I need $1 million of insurance and I pay whatever, my $300 for that, then that's great. But the older you get, and that $1 million of insurance is going to cost more and more. You get into your 70s and 80s, and it could be $100,000 of a premium because there's only 10 of you left.
Yeah.
Right. In the pool or whatever.
Yeah.
So at some point you start asking yourself, is it worth me am I just going to end up putting more than $1 million into this thing before I die and get any kind of benefit back out?
Right.
So that's where permanent life insurance was conceived, where they said, okay, what if instead when we start with the 30-year-old, they just put in a lot more money into the policy than they have to, just for the pure cost of insurance, right? So instead of the $300, it's $3,000 or something, right? But as long as they'll put in that $3,000 every year for the rest of their life, then we can build up this underlying cash value, so that later on when he gets into his 60s, 70s, 80s, there's this additional pool of money that's going to help not only cover the cost, but there's growth on top of that money that's sitting there. And so that can make it so that he can pay an even premium for the rest of his life, $3,000 a year, and it takes care of it. Whenever he dies, no matter when that is, $1 million goes to his family.
When did that start? The permanent life insurance concept? Do you have an idea?
A couple hundred years ago is really, I think, where that started kind of coming about and becoming a thing. So, and the way we know it now, it's obviously evolved, more to where different types of insurance, if it's whole life, we know how the cash value grows based on a guaranteed interest rate and a dividend. If it's what's called variable universal life, that cash value is actually invested in the stock market. So your cash value fluctuates depending on how the stock market is growing or not. And so there are different types of that, but ultimately that's the idea. That's the reason cash value is even a thing inside of life insurance.
Right. So I want to talk a little bit about, not that we're in a global depression or we're headed to one in the, right now or something like that, but it'd be helpful if you could provide some insight into how global events, like world wars, economic depressions, pandemics, how have they impacted this industry?
Yeah, I'll take that one. That's a great question. And really, one of the major benefits of specifically whole life insurance is the stability, predictability, and the guarantees that it's very well known for. And so when you're looking at, global events, world wars, depressions, even high interest rate environments, they've all come and gone. And whole life insurance has just continued to plug along as expected. And maybe to clarify that, there's two ways that a whole life insurance policy grows. You've got the guarantee, which will be anywhere from 2% to 3.75%, depending on the company. And then with mutual insurance companies, you have the dividend. So, that doesn't mean that the dividend doesn't fluctuate, because it does with those different global events. However, those fluctuations are very small adjustments because of the long-term outlook that an insurance company has. Now, if you take other products like variable universal life insurance policies, those are largely affected by global events, and mainly because a variable universal life or a VUL will fluctuate with the market and can easily go negative. So in a depression or any event that changes the performance of the market, you can see big swings in those kinds of policies. And that's really how the index universal life policy came about, or the IUL. Because IULs use an index in the stock market to track the performance, but there's a floor so that if the market goes negative, the client doesn't experience any of the negative years in the market. And because you have that floor, the insurance company gives you a cap on your gains. So you have the ability to capture the majority of the upside, but it's capped on the upside as well. But you do get the protection on the downside.
Maybe you guys need to back up here, because we're throwing around a bunch of terms here, like variable life and IULs and things like that. Yeah. It's probably a good idea I'm sure a lot of people who listen to this have been through some of these things too. But for example, I think specifically when you're talking about variable life insurance, it's a relatively new thing. That's not something that was around during the Great Depression and that kind of thing. So let's back up here. What are these different things? When did they come up and
Sure.
That kind of thing?
Yeah. So originally, the kind of what I was describing with the permanent life insurance, it was whole life. The whole life's been around a long, long time. Buck, you and I were talking a couple of weeks ago, and I brought up this, It's a Wonderful Life, right? You go back and watch that, and obviously that was staged in the 20s and 30s and 40s. And one of the big kind of key moments in there, he brings up the fact that, hey, I have this life insurance policy that has some cash value to it, right?
Right.
So
and that saved him. That was the value that he was bringing to the table in that moment, right? And there are other stories out there like J.C. Penney, using the cash value of his life insurance policy to start his business. Walt Disney using the cash value of his policy in conjunction with starting and using and running, getting Disney going. So again, when you go back and you see these examples, it's been around a long time. But then what happened was when we talk about guaranteed interest and the dividend, it's boring, right? So Buck, you're famous in the last few years of saying, we like boring more and more. That the more we see. Boring sounds pretty good right about now.
Right now, yeah. And that's kind of what happened is people got bored with whole life. So they said, well, can't we make this cash value grow better? Well, yes, you can. Tie it to the stock market and you can. But you get all that other volatility that comes with it.
And when did that really come into?
So VUL was like in the 70s.
Okay. So
when that happened.
Okay, so from what I read about this, basically it sounds like you had the Depression and you had the old-fashioned permanent whole life insurance policies, which were like, they were kind of boring, but they were clipping around paying a reasonable profit. The Depression happens. People are like, oh my God, I'm so happy I have this. And those people, the rest of their lives basically value life insurance so much they don't want to be in the stock market. And then eventually they die and their children forget everything that ever happened during the Depression. Yeah. And the next thing you know, they're seeing people make lots of money in the stock market. The insurance industry says, hey, maybe we ought to get in on this so we can at least make these products more attractive to these people. And then the next thing you know, you've got this VUL thing, right? Is that about right chronologically?
Yeah, and that's also when the 401k came about in the 70s, et cetera, right? So everything was moving toward the more using the stock market for sure.
Got it. So how did because this is the variable life insurance is the one that, it's probably not a great idea necessarily, right? I mean, it's not done particularly well. So talk a little bit about what happened with that.
Sure. Okay. So the 70s led into the 80s, high inflation, high interest rates. Again, whole life was already seen as kind of this boring thing. And especially you can imagine interest rates are at 18%. The policies, they were paying higher than what they are now. But if it's paying out 10% in the whole life policy, but you could go to the bank, get a CD for 16, then it's, it's like nothing. So that's where VUL really became more popular. Is that, inflation drives the markets higher, right? Values across the board go higher. So they say, well, let's do more on this. And then, the market, it has volatility. Right. So if you're relying on that for your cash value, for your life insurance to be able to pay out and it's struggling, right, you maybe get overconfident in the 90s. And then in the decade of the 2000s, you've underfunded it. Now all of a sudden it's risking going away, because the dot-com bust and then, the real estate thing.
So just mechanically, this is literally like this money or these cash accounts that are invested in the stock market. Mm-hmm. Right. And so that's the thing. So you're basically in the stock market. So you're going to live and die with this thing. Right. Yep. No pun intended for insurance, but you're going to live and die with this thing. Then the problem was there that, you get the next crash and a lot of people die. Not a lot of people die, but their portfolios die.
Yep.
their stock portfolios, and then boom, all of a sudden, variable life insurance does not sound like it's such a good idea anymore because you've lost 20-30% of your portfolio in a crash, right?
Yep.
So that's how I think a lot of people think about it. Life insurance now. I mean, I think that's one of the things that seems to have gotten people, scared about it over the years. And I think it's also given ammunition to some of the, those individuals who are, who make money managing people for assets under management, right? Like it's,
Yep.
But then comes along, I think, another option. Well, there's a few things that happen. The concept of overfunding. When does that start? And first of all, tell us what overfunding is and tell us when that starts.
Yeah. So let's go back to my previous example of the 30-year-old that's going to pay $3,000 a year for the $1 million policy, right? That's going to build cash value inside of his policy over time. And kind of take care of it in terms of the way I described. But what if all of a sudden he looks at that and he says, man, that cash value, it's growing, it has guaranteed growth and the dividend. And then the IRS also gives it tax benefits so that as it's growing, I don't get a 1099 at the end of each year. When I want, if I want to start using that money, I can tap into it without paying taxes on it. This is actually looking really good. What if I want to do more, put more money into it? Well, initially there was no mechanism to do that, right? It's the money that got in there was through premium, paying for the life insurance. So how do we get more in there? So then the companies developed what's called paid up additions. It's a rider that you can attach to the policy. And it actually does create more insurance when that money goes in there. But the way that we use it is we think kind of what you're using, the word overfund. We want to put more money into it to get more of those benefits, more dollars receiving those benefits inside of the policy. And so, for example, if we have someone who's putting $100,000 a year into their policy, 20 of that might be the core insurance part of it, which does build cash value. But if we can do an additional 80 that goes in there and it's growing, it's doing its thing, and we're catching the 5% plus return, the tax benefits, and we can access it and use it, then that's kind of the whole basis of the wealth formula banking strategy, right?
Right. So again, let's stratify that a little bit because we're kind of we've got a few different things going on. So we went back to this whole life insurance, which is the original idea, and in that situation, it's more fixed returns, right? Have, for the most part, it's fixed. I mean, you have a fixed return, and then you have additional distributions coming in based on profitability of an insurance company, effectively, right? Mm-hmm. So that we said, okay, now you can overfund that, and the value of the overfunding is what at that point?
Yeah, the value of that is again, the way that we use it is now you have more money, you're able to take advantage of those benefits, the guaranteed growth, the dividend, the tax benefits, and
then you can borrow against it.
Yes.
And the real thing that we've always talked about with wealth formula banking is not that, we're just impressed by the returns that we're getting, although the returns might be looking pretty nice right about now. Mm-hmm. We're more interested usually in borrowing and then amplifying other cash flowing investments.
Yeah. Basically, we compare it to what are your other options to use for your opportunity fund where you set money aside to actually go out and invest with it. Well, if you're using a bank account, a money market account, you put that money there, and when you're ready to invest, you take money out and you go out and invest it, right? You're no longer earning anything there. While you were there, you might have been earning something, but you had to pay tax on it. With this, you put the money into the policy, it grows tax deferred, so you're not taxed on it. When you're using it, you're actually taking a loan against it. So your money stays there and continues to grow, creating value in multiple places at the same time. But you're still investing in all the same things as you wanted to in the beginning, right? So it's just a much better opportunity fund than the regular savings account.
Yeah. So basically you're investing the same money two places at the same time. And effectively, in addition to, amplifying your returns, now you have protection for your heirs in addition to that.
Yes.
So that's why I think it's wealth formula banking has been really compelling. But then let's talk about so let's leave that behind now. And let's go back to this whole concept, the variable life insurance, the one that was sitting there in the stock market getting destroyed on Black Monday or Tuesday, whatever. Mm-hmm. What was the one in the 80s? I can't remember. Was it Tuesday or I think it was a Tuesday or something like that.
Yeah, I think you're right.
Okay, so you get pummeled in the 80s and everybody's losing their money. Variable life insurance sounds like not such a good idea all of a sudden. And then comes along this concept of indexed universal life. And how is that different?
Yeah, indexed universal life is really just, they said, hey, how can we capture the majority of the upside of the market, but not have to experience the downside of the market? And so all they did was, it's a lot of the same indexes that are available for the VUL that you can be invested in. But they put a 0 or 1% floor. So if the index goes negative for the year, you don't experience the negative year. And then they put could be anywhere from a 10 to 14% cap. So if the index goes up by 20%, your cap's 14, you're going to capture 14% in the IUL.
Yeah. So what's interesting about that, though, is that, again, you've got people say, well, shoot, this market is blazing hot. And what if it goes up 20% and I'm capped at 14? That's where the leverage comes in, right?
Yeah.
So
yeah,
talk about that, because effectively that's what the leverage does, is it allows you to capture not only that cap. In this situation, it's almost like that's like your cap rate, and then you've got amplification that gives you higher returns on that. So I think you've done some math on this, right?
Yeah. So now you're talking about what we call wealth accelerator or velocity plus, where we have an IUL policy out there. You've put some money into it, but in addition to that, we've taken a bank loan for more money going into it. That's creating the leverage in the same way as we leverage, buying real estate or leveraging your business. We're just doing the same thing to build this asset, which is inside of the life insurance policy. And because of that leverage, it amplifies the growth rate. So in other words, if the policy itself is going to create roughly a 5% return, someone might say, 5%, that's not all that exciting. But if by using the leverage, I can turn that 5% into 11, 12, 13%, and that is tax-free, well, that's the equivalent of like a 18 to 20%
right
return on with a taxable equivalent kind of other investment. So now that starts to look much more attractive.
Yeah. And so in that situation, that basically starts to sound almost too good to be true, right? Because I mean, with, when we talk about the banking thing, it's basically, okay, now I'm wealth formula banking. I'm going to invest the same money in two places at the same time, and I'm going to get protection for my family. And this is an extraordinarily stable investment. So, hey, that's great. Index universal life sounds like, hey, I can take, essentially, if I add a little bit of leverage to this, then I can take returns that are higher than the market is actually returning because of my leverage.
Yeah.
And my floor is maybe even 1%, right? Like it might not even be 0. It might be 1%. So I'm not going to lose money if the market goes down. If the market goes up, because of my leverage, I'm going to get a return higher than what the market actually did. Mm-hmm. Again, sounds a little bit too good to be true, right? So then it makes you think, well, what the heck? How could they do this? So how can they do this? How can they do this? People ask this all the time, Rod. I think it's a very good question, especially because you're talking about some of the most stable companies in the world, right? Have been around for well over 100, 150 years, mm-hmm. that have, the optional dividend has never been optional to them. They've always given it out. How are they doing this and still staying afloat?
Yeah, it's a great question. It has to do with what they are, like these insurance companies. So take the 30-year-old or even take a 60-year-old. If I am an insurance company, I'm starting a policy for that person, I'm not expecting them to die for at least for a few decades, mm-hmm. right? At least. So I have to plan what I'm going to do with the money that they give me today so that I'm ready to pay it out whenever they die. But again, most likely in a long time. So when they go out and invest, they're investing in long-term bonds and notes, 30, 40, 50-year types of things. So it kind of levels it out. Going back to the boring time in the 80s when interest rates were higher. Well, the whole life policy, again, right now it sounds amazing, right? They paid out double digits, 10, 11% when you combine the guarantee and the dividend. And yet at the time it was like, But then over the last 10 years, when interest rates were basically zero and the insurance companies with the guarantee plus the dividend were paying out 5, 6, 7%, well, that sounded amazing, right? So it kind of takes these short-term fluctuations of the economy and just kind of levels them out over a long period of time. So trying to time the market, trying to, whatever, all the different things that you talk about in terms of investing, you don't have to worry about that. Like you just get in and IUL ends up doing a similar thing. When you spread it out over a long period of time, it creates a pretty predictable growth rate for you. So if I'm not worried about what's happening now in the next 2 years, I can spread that out over 15, 20, 30 years, then it actually works out really well so that even when we have times like now, because we get asked this all the time, right? Especially with the leverage, with interest rates going up, doesn't that kind of throw the wealth accelerator out of whack? And the answer is no. The answer actually is the rise in interest rates are going to be good for it in the long term, right? In the short term, it pinches it a bit, right? Because the interest rates on the loan went up, but the market's struggling, so I'm not earning on my IUL, et cetera. But the higher interest rates now mean that the insurance company has higher quote unquote budgets when they're going out and buying options on the market in the IUL. So caps are going to go up. They already have been, right? Like the Fed started raising rates in July. By August, these insurance companies were already starting to increase their caps on the IUL. Like it's responsive to that. And on the whole life side, there's a little bit of a lag, but the rise in interest rates pushes the dividend higher because the insurance company is able to get higher returns in their investments. That pushes the dividend higher.
So what are the insurance companies like? What do their portfolios look like? Because obviously they, take Penn Mutual, for example, right? Which is a lot of what I think you guys use. Mm-hmm. Penn Mutual's been around since what? 18 something?
1847.
1847, and they've never missed a dividend.
Ever since 1849, yeah.
1848 was a bad year, I guess. I don't know, but
I guess they were still getting the pool together,
figure themselves out. But so since 1848, 49 or whatever, they paid out a dividend. So what is a company like Penn Mutual actually invested in that allows them to have such continuity in times like the Depression, the times like like even hyperinflation,
world
wars, and the pandemic, and all of these things, these still rock solid. I mean, in some ways, it's more stable than historically than any bank out there, if you think about it.
Yeah. Well, I think that's helpful to make that comparison. And I have a really kind of funny story for you. So here a couple of months ago when Silicon Valley Bank was falling apart, a couple of weeks later, I got a call from one of our clients, large business owner, been around a long time, had life insurance policies since even before we met him, right? For a long, long time, he's been a believer in it. Well, he calls and he says, "Hey, Rod, if I send a check," so he's funding a well-formed banking type of policy, $300,000 a year. He says, "When does my next anniversary come up so that I can put more money into it?" "Oh, well, you're 3-4 months away, so it's not quite time yet." He says, "Well, if I send them a check for the $300,000, what are they going to do with it?" We're like, "Well, I don't know. They deposit it first, and then they'll decide where they're going to put it. But when they see they can't put it anywhere, they might send it back." He's like, "As long as they deposit it, I'm good because I don't want it sitting in my account. I feel much better if I can get it to them. Even if nothing happens with it for 4 months until my anniversary, then they'll credit it to my account. I'm totally good with that." I was like, "Okay, we'll see what we can do." Right. So, but here he's thinking, man, I again, a business owner keeping large reserves. He owns several pawn shops. And so you can imagine cash fluctuates dramatically in his business. So he has to keep large amounts of cash. Well, where does he keep them? he keeps it in his life insurance policies, and he accesses it. He takes loans out on a regular basis, sends big chunks back to pay down the loans and or to continue funding it. My point is, he's looking at the comparison, someone who's been around life insurance, the whole life policies for a long time. And he clearly saw, man, this is a much more stable place. And okay, so now back to your question. Why is that? Banks, for the capital that they show on their books, how much liquidity do they have?
It's like a 10 to 1 or something now? Or
yeah, 10%.
Yeah.
I think is what you think of as a general rule. I think for most of them, that's a high point. A high water mark might be 10% liquidity because they're out, fractional reserve banking and taking your dollar and then going out and loaning it out multiple times because they can, right? And that's how they make their money, right? With the life insurance company, you put that money, you pay your premium, and when they're setting that money aside in their reserves, they're keeping, for every dollar that they have promised out at any given time, they have more than $1 in reserves for that. So you mentioned Penn Mutual. I think the last number I heard was like $1.13 in reserves for every dollar they have promised out. Okay. So what are they invested in? What's interesting is they're invested in a lot of bonds, right? And recently when I say bonds, people freak out and they say, oh no, that's what, pushed Silicon Valley Bank into,
well, they probably have
default,
ones,
that kind of stuff.
Well, they probably have them from way back when they were, when they were high, when the bonds.
They do. Yeah, they do have that. And they have a lot of short-term stuff as well, because recently it makes more sense to put it into a 2-year or a 5-year bond instead of going out and getting a 30-year for less. But the point is that, number one, there's no run on an insurance company, right?
Right.
And the reason for that is it's not that people couldn't, like everybody who has a policy with them, everybody who has cash value could say, no, send me, even if it was a loan, like, hey, I want to take out my max loan, send me all my money. But in reality, I heard recently an executive from one of these companies saying that they have no more than 7% of the policies on their books, these whole life policies, that have any loan against them. So the fact is, the majority of people who have money in these policies are leaving it there to just do its thing, not using it the way we use it, right, in the wealth formula banking. So there's no such thing, or historically has not been anything like a run on a life insurance company like you get a run on a bank. And so you put those things together, and it's just like, if I had to say, what are the last companies standing in the United States if just everything goes wrong? And I think it's life insurance companies.
Yeah. So again, it's sometimes when whenever we talk about this, I'm like, gosh, it just seems like too good to be true. Right. But it's not like we've got companies that are fly by the night companies sitting here. We're talking about 170-year-old. I don't know. I have to do the math. But,
yeah. Right.
Companies that are doing this kind of thing. So, let me ask you this. So what are some of the most common, if you want to call them misconceptions, or if you want to call them misinformation, because there's a lot of misinformation about insurance. That's one of the things that I realized early on, right? Like when I came out of residency, and I remember some guy telling me, well, whatever you do, don't buy permanent life insurance. It's dumb. Buy term and invest the rest. And, he seemed to know what he was talking about. But then the next thing I was sort of making some money, and I was in these various groups with a bunch of wealthy business owners, and a lot of them were doing various types of premium finance. Yeah. And I was like, these guys aren't dumb. These guys know what they're doing. And meanwhile, this doctor that was like 1 year out of residency in front of me was giving me all this advice, like he knew everything. So what's the discord there? What's the confusion?
Well, I think a lot of it is what people are used to seeing when people talk to them about whole life or index universal life policies. They're used to seeing policies that seem to have an extremely high cost. And it's because they're looking at these policies purely as a death benefit, or the person showing them the policy, whether it's a financial advisor, insurance agent, whoever it may be, they're selling them the policy as a death benefit play. And that's just not the conversation that we have around wealth formula banking or the wealth accelerator. And so it has to do with the structure of the policy. Those policies are structured purely to maximize the death benefit, whereas the policies that the wealthy use are structured to maximize the cash value that you can utilize for investing. You can utilize it with leverage for tax-free income. And I think that's the biggest discord there is people are used to seeing one thing and seeing high cost and just a death benefit at the end of life instead of this very efficient policy. It still has cost, but those costs are minimized and you can utilize it while you're living.
One of the things that, I recently converted a wealth formula banking policy to a wealth accelerator policy. And I did that in part because what I realized was that I deploy capital so quickly. Like the idea of taking loans from the banking policy, it just wasn't really happening because like I was just putting money in and then I'd as soon as I got money in my pocket, I would just deploy it. Right. And then I thought to myself, I don't really have any exposure to this stock market. I just don't. It's like, and by the way, I don't recommend that. It's not like I'm saying that, you have to be all alternatives. I just was. But I think it's smart to have exposure in various areas, especially when the market's kind of been beat up and all that, to have some exposure, especially if you can, as we've talked about here, take the upside and actually take more than the upside, not lose money. And so decided to move forward with this wealth accelerator. So do you want to talk about how, I'm happy for you to just share what we did and kind of explain what that does, how that works, Rod.
Yeah. So your whole life policy, that was the wealth formula banking policy. You've been funding it, max funding it, getting that money in there. And then, like you said, you weren't tapping into it the way that you had planned to, or even that you had previously done, when you first got excited about the strategy and were using it. And I mean, I think in some ways that's you're a little bit unique in that sense, because as as a general partner, or as in the ways that you participate in a lot of these investments, your return or your like capital outlay is different than maybe it was before that. And so you were saying, okay, well, what can we do with this, right? How can we make more of this instead of, again, letting it sit there and grow 5%? Not the worst thing in the world. It's liquid. You can access it if you need to, but how can we do more with this?
And by the way, this is something I think like a lot of people, this is not taking away anything from wealth formula banking, because I know a lot of people who are using it very efficiently, but there's also a number of people like me who probably, kind of have it there and they're overfunding and they had intended to do something with it, but then they really haven't. So this is another option for them.
Absolutely. Yeah. And it's kind of, we're in a weird kind of place, because a lot of people who viewed wealth formula banking the way you described it, where it's like, man, I just deploy my money so fast. Well, what are they doing right now?
Nobody's deploying
They wish
anything.
they had more opportunities to put the money into, but they don't. So it's actually a really good opportunity. If you saw value in wealth formula banking, but weren't participating in previously because of that, now is a great time to be capitalizing, so to speak, your policy, so that in a 6 months or a year or two, when things start breaking loose, the money is there and available. It's ready to go and use. But it's also been working for you in the meantime.
Yeah, okay, that's right.
A little aside, but I think that's an important point that we've been seeing with people over the last 6-8 months.
Yeah, and by the way, again, this is I think the Wealth Accelerator is something to seriously think about if you are sitting on cash and you're like, what am I going to do with this? There's nothing really good right now, and I think there will be some good stuff coming up here pretty soon. But I mean, if you're sitting on a lot of money and you don't want lazy money sitting around, tell us a little bit about Wealth Accelerator and how that works.
So that's the flip side is we take this cash that you have sitting in that policy and now we're putting it to work. Again, it's going to keep earning the 5%, but instead of you continuing to put the annual contribution into it, instead we're financing that through the bank. So the money is continuing to be max funded into the policy the way it was originally intended. The cash value is going to grow the way it was originally built to do with the 5% return. But now because you're using leverage to get that money in the long term, you're going to not have a 5% tax-free return. You're going to end up with something much larger than that, right? And in addition to that, you have the money that you were planning to put into it. So instead, we're going to start stacking policies. In your case, we have this large amount of convertible term insurance. And then so instead of you continuing to put your money into that original policy, we'll start stacking additional whole life and IUL policies on top of that to just make that bucket bigger and bigger and bigger. And the more money that you will be taking as loans as leverage to continue building that bucket, so that in the future, when it either turns into a source of tax-free income in retirement, or as more likely in your case, as you anticipate it being an estate planning play, your girls will get a lot more death benefit, like multiple times more death benefit out of this by you having used the leverage than it would be if it was just your regular contributions having gone in.
So now, right now, like people hear leverage and they're like, oh, I don't know. I'm a little nervous about that. We got interest rates going up. How does leverage work here, and how safe is it to use in the context of these policies? Yeah.
So we use the term conservative leverage because, again, we want to use it as a tool, but we don't want to go crazy and go overboard with it, right? So in this case, with Wealth Accelerator specifically, the asset, the life insurance policy that we're building, you put the money in first to get it jump started. And then now, as we're adding more money to the policy through that leverage, it continues building the cash value of the policy. You're going to always have more in your cash value than the loan balance that we're creating, right? So that's the first point I think is really critical to realize. Because I'm also often asked, well, why do the banks like this if they don't like a lot of other things right now? And the answer is because it's a cash equivalent asset that is very predictable in the way that it grows. The same reason you talked about that you like it, that the banks like it as collateral for a loan as well, right? So all of those principles work for you in kind of building this additional benefit, but it's doing it in a way that is it's very calculated. It's very, again, conservative, so that we don't have to worry about it. And I'll give you an example. Because people say, well, what banks are you using right now for this? And interestingly, we're actually not using banks at this moment. We're actually using the insurance companies. And why? Because if we were to use the banks right now, we would be paying 7.5%, 8% interest, right? Whereas if I'm on the whole life side, it's a 5.7% interest rate. On the IUL side, it's a 5% interest rate. So we have, because of the instrument itself, the cash value line of credit, it just gives us a lot more fluidity to be in the right place as it relates to how we're using the debt. So, and like I mentioned earlier, the rise in interest rates is going to mean that the policies will produce more growth moving forward than they would if interest rates hadn't go up. I like the fact that the interest rates went up. I know it gets creating havoc in a lot of other places, but as it relates specifically to life insurance, I think of it as like an interest rate reset. When interest rates were low and had been low for so long, it just makes it tough for the insurance companies to think that they can keep paying a higher, reasonable dividend or with the IUL to have reasonable caps. But with interest rates going up, that puts us to a healthier place as it relates to that. And the interest rates on the loan side are not going to stay high. If you go back to the 80s, they went really high, 18, 20% at their highest in like the 1980, 81. But by 1985, 86, they had dropped to 5, 6% again. But the effect of having had the high interest rates and the insurance companies going out and buying 30-year bonds at those 18% rates means that the insurance policies were bolstered for the next, decades.
So when we did mine, speak to the mechanics of that, because we started with a whole life policy. So presume you can't switch Can you?
Yeah, it's not that you can't, but it wouldn't be smart at this stage to do that.
Right.
In other words, the costs are higher in year 1 and 2 of the policies. You're already past that point. We don't want to go back and start over with that on the cost side. So keeping the whole life that you have as your starting point, and then when we start stacking the policies, then we'll go heavier on the IUL first.
So what we do there, again, mechanically, I want to make sure we understand, everybody kind of gets an idea how this works. You say we take the loan. So the nice thing about Wealth Accelerator 2 is like you don't have to do something every year. It's in effect, it's like a one-time deal. You can do it every year if you want, but you're not required to do that. Because I think that's one of the things that's kind of nice about it is you're not putting yourself on the hook for, I don't know, $100,000 a year for 5 years, and then all of a sudden you have a bad year, and you're like, oh shoot, there goes that plan, right? So that's one thing. So then so you put the money in the first year. Is there loan coming in for the first year at all?
No, not in the Wealth Accelerator.
So the second year, you're not putting any money in. Where's the loan coming from? The insurance company?
Right now, yes, the insurance company. Yeah. And traditionally we'll use a bank. Like there'll come a time where we'll go back to using banks, but
but in that case, your loan that you're taking has to be, at least a tiny little bit below the amount of return you're getting in order to amplify that return.
Yeah, and it's both. So, for example, in that year 1, you mentioned 100,000. Let's say you put the 100,000 in. Now, in the cash value of the policies, you have 75,000. Okay, I'm just using a really round number. So 75,000 is there. When in year 2, when that next 100,000 goes in, it's going to increase the cash value by about 88,000. Right. So in other words, you now have $100,000 loan, but you also have 160,000 sitting in the cash value. And then getting back to your point, the interest that you end up accruing on that loan over time, on average, you'll earn more in the policies as far as a rate, like the interest rate that you're earning compared to the interest rate you're accruing on the loan. So not only is there a difference in the values, but there's a difference in the rate. We call it the spread, so that we end up outpacing the growth in our cash value compared to what we're accruing in interest on the loans.
Got it. Okay, so now you can also do that policy, that same type of thing with the IUL. And you started, if you have an IUL, you can do that. By the way, you can't convert a leveraged IUL that you already have into this, right? Or an IUL in general?
Well, you could. Again, in the similar way that I think of it as like repurposing. Your wealth formula banking policy was being intended to be used for investing and that kind of thing. When you realized, hey, maybe I want to do something different with this, we took the exact same policy, exact same structure. We didn't change anything on the policy itself. We just repurposed it and moved it over into the category now of Wealth Accelerator because we're now financing the premiums going in. And then we add to it with some IUL, with some other things to really build it into what you want it to be in the future.
Well, anyway, we could go on and on forever on this. You can obviously you can do the same thing with Wealth Accelerator. You can do that with the IUL, and that's like, I think in some ways it's probably a much more conservative option than traditional premium finance.
Yes.
Premium finance, because you don't have any recourse on that debt either, right?
Yeah, you're always 100% collateralized by the cash value. Like I said,
right.
By design, your cash value is always a larger number than what your loan balance is.
So anyway, anyway, good stuff. Finally, I guess, we've talked a little bit about the mechanics of some of these policies and also the history. I guess we can just finish with this. I mean, what lessons can we learn from the history of permanent life insurance and how to use them? How to think about them in the larger context, because they've gone through periods when they have been, a lifesaver. They've gone through periods when people just thought, oh, boring, can't make any money. So how do you contextualize that?
Yeah, I think that, insurance companies that we use have been around for 150 plus years. So, we've covered that. We've covered that they've gone through different global crises and they've been able to navigate those very well and consistently continue to pay dividends to policyholders, which means they're profitable every single year. So, one thing that I take away from that is that it may not be the most exciting thing to have, but it's definitely going to be here for the long term. It's conservative leverage. It's the ability to use your money in two different places at once. And the underlying asset is, it's something that you can count on.
And maybe just to build on that, it's as Brendan talked about earlier, it's building it in the right way. Like it's taking the tool of life insurance and setting it up correctly, like in this case, to minimize costs, maximize the growth of the cash value, to use whole life where it makes sense, like in the wealth from the banking, that's we're using whole life, right? Can you use IUL? Yes, you can. We choose whole life because of just the really predictable growth that we get inside of it. You don't have to worry about what's happening in the market at all because there's no correlation to the market with it. Whereas with the Wealth Accelerator Velocity Plus, we use IUL. Well, Accelerator, we actually use a combination of both whole life and IUL because we want to take advantage of the strengths that they bring to the table without, again, in the case of IUL, without, having issues with some of the weaknesses, right? They balance each other out in that sense. So that when you talk about, what lessons do we learn? Well, we learn that when set up in the right way and used as a tool to grow wealth, they can actually be very, very effective at doing that.
Thanks, guys. I appreciate you being on Wealth Formula Podcast again. Thanks again, guys, Brennan and Rod, for being on Wealth Formula Podcast. I think this is something that people need to be thinking about right now or should consider, especially if you're worried about the way things are going. This, again, has been a savior for people in the past. And, it's one of those things, sometimes boring is good, and boring is kind of like what will sometimes save you on a rainy day. So if you're interested in these kinds of things and want to learn more, go to wealthformulabanking.com. There's a few webinars there where you can dig down deeper. And then ultimately, if you're interested, contact Rod and Brennan or Christian through that just by sending in a little filling out a form. Again, guys, thanks again for being on Wealth Formula Podcast, and I'd love to have you on again soon.
Thanks, Buck.
Thanks, Buck.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. And again, this is just something to consider. I think permanent life insurance is something I believe in and probably will be doing a little bit more of, even as I wait for, some of the blood in the street to come and deploy capital. But, this is something that I think that if you think about what we discussed in this podcast, there's in many ways you can just look at it and say, well, why wouldn't I do that? I mean, that's the thing is when you drill down on this stuff and you talk to Rod, talk to Christian or Brennan about it, some of these policies just make you wonder why what the downside really would be. But decide for yourself. Think about it. I just wanted to put it on your radar. Go to wealthformulabanking.com. Make an appointment with those guys. Let them, ask all the questions you want. It's out there, something to consider. But that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.